Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In last week's episode, we discussed why the Bank of Canada remained on pause after the last meeting and hasn't cut interest rates since March, and why we think they should continue to hold the line and not cut rates below core inflation. In this week's episode, we are going to discuss the one reason why we think they will, the labor market. However, before we get into that, I want to remind you that Canada's central bank, the Bank of Canada, has but a single mandate: inflation, 2%, with a 1 to 3% range. Unlike in America, where the Federal Reserve has two, inflation and full employment. There are, of course, pros and cons to only having a single mandate. It offers simplicity and strong inflation control, whereas a dual mandate provides flexibility and can align with societal goals, allegedly. But the dual mandate risks more complexity and conflicting priorities. A single mandate may work better in stable economies with low structural unemployment, while a dual mandate suits economies with a more volatile employment cycle. And finally, single mandates may strengthen independence by narrowing the scope of political interference or influence, while a dual mandate requires careful communication to maintain credibility. This limited mandate might seem harsh, but there are always trade-offs. Foregoing central bank independence in a crisis to meet some political aim might seem like a good idea at the time, but it can lead to major negative outcomes. A clear example of this is when the Bank of Canada monetized the debt issuance of the federal government during COVID by, yes, printing billions of dollars. We covered this in depth in episode 37, but in short, by running cover for the insane budget deficits of the federal government, the Bank of Canada stoked consumer price inflation, which crushed the poor, and simultaneously artificially lowered interest rates, fueling an asset price inflation and permanently putting housing prices out of the reach for a generation of young people, not to mention the negative effects on inequality in Canada. Last week, we discussed why the BOC remains concerned about inflation, despite the tariff impacts so far being muted. As discussed in episode 46, the Bank of Canada's three preferred measures of inflation have been rising for months after bottoming late last year, and inflation breadth, highlighted in the monetary policy report, is also rising. So if there remains clear evidence that the inflation problem is not going away, why might the BOC cut rates in September, their next meeting and opportunity to do so? Well, it's because the labor market is cracking. And yes, this means we question their independence and their commitment to their single mandate. Now let's briefly dissect the job numbers. After a smashing June figure of 83,000, the July labor force survey employment number fell by 40,000. The economy has been sluggish, and the uncertainty over tariffs have hurt staffing decisions and continues to weigh on overall sentiment. But blaming the trade war, although politically convenient, misses the trick. Canada's labor market was deteriorating long before Trump's boorish politicking, as we can see from the chart. But mercifully, overall unemployment remained steady last month. The unemployment rate held steady at 6.9% in July because of the declines in the rate of unemployment for prime age workers and baby boomers, which offset the rise in youth unemployment. Those aged 15 to 24 continue to face a very challenging labor market because of weak growth and the lagged effects of the insane immigration policies Canada has been subjected to. The upshot, youth unemployment fell to 53% in July, the lowest rate since November of 1998. And if you remember in episode 41, we talked about youth unemployment at a 50-year ex-COVID high. A breakdown of where the jobs were lost highlights the underlying weakness that steady unemployment papers over. Private sector unemployment fell, while, of course, public sector grew again. Although public sector employment is essential for providing public goods and supporting the private sector's success, in Canada, we have a problem. The public sector's massive, outsized contribution to employment is a major red flag. Since January of 2019, it has contributed 41% of all employment growth. This is bananas, and an indictment on the underlying health of the economy. Public sector employment in Canada is now at a 30-year high at the same time as its productivity continues to fall. This is not a good or sustainable situation, especially when we consider that the government's tax take is at a 20-year high relative to GDP, and deficits are set to explode in the fall when we finally get the number. And of course, there's zero political will, seemingly, to rein it in. Again, this is not good for investment or productivity, which is what Canada is desperately lacking. Shifting gears a bit, we look at the participation rate for prime-aged workers and the employment rate for the total economy. Participation rate shows the proportion of this age group actively engaged or seeking work, reflecting workforce availability and economic engagement. This key metric has been very high and has held up very, very well, but is now trending lower, which again is not good. The employment ratio is especially jarring. After years of relative stability, it has collapsed. This means population growth is outstripping employment. Remember, this is also at a time where private sector employment is falling. This means fewer workers to pay the growing tax bill. Employment ratio collapse is happening in part because of the insane immigration policy that Canadians were subjected to. Now, immigration that was completely out of control has since slowed dramatically, but the damage is largely done. Since June of 2022, Canada's population growth has jumped by nearly 3 million people, again, mostly by immigration, and this has massively outstripped employment. Furthermore, when we consider that 40% of the labor force survey jobs are public sector, it demonstrates how unserious the current government has been. And to be crystal clear, these policies overwhelmingly and disproportionately disenfranchise the young and working class and benefit the old and the asset holders in Canada. It was reckless and completely unsustainable. We mentioned earlier this year that the January figures might prove to be the cycle peak, and we were wrong about that. The 83 number that we got last year put the total employment above that January peak number, and the labor force survey continues to diverge from the survey of employment payrolls and hours. However, my gut tells me that the June job growth figure we saw will probably be revised down over the next month. This divergence is, over the long term, unsustainable, bringing the LFS, or Labor Force and Survey Employment data, closer in line with the survey of employment payrolls and hours. As we wind down this week's video, we should check in on our overnight index swap curve, where market participants can essentially bet against certain outcomes and hedge their interest rate exposure. And as we can see right now, there's a 67% chance of a no cut in September. But it's a little too early to read anything into this just yet, so stay tuned. And finally, my favorite chart. It's my hope that the BOC remains truly focused on its single mandate and resists the urge to lower rates below inflation, i.e. keep real interest rates positive. I think that's where Canada's monetary policy went wrong, circa 2010 in red, and it helped fuel a housing bubble and siphon away capital from non-residential capital investment. If inflation continues to rise and the BOC ignores that in favor of trying to support the economy writ large and employment, I think we'll again go down a bad path. Ultimately, it will hurt productivity growth. All right, that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.